Think you know the secrets of building wealth? Think again. The industry hides the truth about fees, taxes, and other pitfalls that eat away at your money. From the sneaky impact of tiny fees to the erosion by inflation, I'm here to spill the secrets. Stick around to get the real deal in simple, everyday language. Smash that like button, hit subscribe, and let's uncover the truth together. Let's get into it. Compounding is one of the best ways to grow your money, but it takes time to see big results. You need to invest for the long term to really benefit from it. At first, compounding can seem slow. If you invest $1,000 each month and earn 10% a year, it might feel like you're barely making progress in the beginning. This early stage is mostly about your initial contributions and small returns on those contributions. It can be frustrating and test your patience, so it's important to keep thinking long term. The real power of compounding kicks in after a few years. Your returns start generating their own returns, and your money grows faster and faster. For example, it might take almost 10 years to reach your first $200,000, but getting to the next $200,000 will take much less time. This rapid growth is the true beauty of compounding, turning small, steady investments into large sums of money over time. To take full advantage of compounding, you need to be patient and stick to a long-term plan. Avoid the temptation to chase quick profits. Instead, focus on regularly investing over many years. This way, you can see how powerful compounding can be, transforming modest investments into significant wealth. Patience and consistency are key because the biggest rewards come to those who let their investments grow over the long haul. Even though ETFs, exchange-traded funds, have lower fees than other investments, these small costs can really add up over time and reduce your final returns. This fee, known as the expense ratio, might seem minor at first, but becomes more significant the longer you invest. Take an ETF with a 0.2% annual fee, for example. It might not seem like much, especially when compared to mutual funds with the 1% or higher fees. However, over 30 years, these small fees add up. If you invest $1,000 each month and earn a 10% annual return without any fees, you could end up with around $2.08 million. But when you include a 0.2% annual fee, your final amount drops to about $2 million. That's an $80,000 difference due to the fee. Fees reduce your returns by taking a portion of your earnings each year, leaving you with less money invested to grow. Over time, this reduction compounds and leads to a much smaller final amount. It's important to be aware of how fees impact your investments. Look for the lowest cost options to keep more of your money working for you. Regularly check and compare the expense ratios of your investments to make sure you're not losing more to fees than necessary. By minimizing fees, you can maximize your returns and grow your investments more effectively. Capital gains tax can really cut into your investment returns. When you invest in things like stocks, bonds, or real estate and sell them for a profit, you have to pay taxes on that profit. This tax can take a big bite out of your earnings. For example, if you invest $1,000 each month and get a 10% annual return for 30 years, you might end up with about $2.08 million. However, around $1.64 million of that is profit, which is taxable. If the tax rate is 20%, you would owe about $328,000 in tax, leaving you with roughly $1.75 million. These taxes reduce the benefits of compounding because they take away some of your returns every time you sell an investment and make profit. The more often you sell and pay taxes, the less money you have to reinvest and grow. To lessen the impact of capital gains tax, try holding onto your investments for a longer time. This buy and hold strategy lets your investments grow without the constant hit of taxes. Using tax-advantaged accounts like IRAs or 401ks can also help, as these accounts defer taxes until you withdraw the money, usually during retirement when you might be in a lower tax bracket. By understanding how capital gains taxes affect your investments and planning wisely, you can make the most of compounding and grow your wealth more effectively over time. Inflation is a big factor that can reduce the buying power of your investment returns. While compounding can grow your investments a lot over time, inflation lowers the real value of this growth. This means that even if you accumulate a lot of money, its actually buying power will be less because of inflation. For example, if you invest $500 each month and get a 10% annual return over 30 years, you might end up with around $1.04 million. That sounds great, but if inflation averages 2% per year, the real value of that $1.04 million will be much less. Inflation makes your money buy less over time. So after 30 years, your $1.04 million might only be worth about $432,500 in today's money. This shows how inflation can quietly eat away at your returns. To fight this, consider investing in things that usually grow faster than inflation, like stocks, real estate, or inflation-protected securities like TIPS, Treasury Inflation-Protected Securities. Also, try to increase your investment amounts in line with inflation to keep up the real value of your money. Understanding and planning for inflation is crucial. This way, your accumulated wealth keeps its buying power over time, helping you meet your financial goals effectively. Sequence of returns risk is important for investors to understand because it shows how the timing of your investment returns can affect your overall results. This risk is all about when you get your returns, not just how much you get overall. Imagine two investors who both earn an average annual return of 7% over 30 years. If one gets high returns early on and lower returns later, while the other gets lower returns at first and higher returns later, their final amounts will be very different. The one with high returns early will likely end up with more money because those early gains grow over a long time. In changing markets, putting in the same amount of money regularly can lead to different outcomes because of this timing. For example, if you invest $500 each month and the market drops early in your investing period, it can hurt more than if the drop happens later. Early losses mean you have less money growing over time, making it harder to catch up. To deal with sequence of returns risk, you can use strategies like dollar cost averaging. This means you invest the same amount regularly no matter what the market is doing. This can help balance out the ups and downs. Also, spreading your money across different types of investments can reduce risk. Understanding sequence of return risk is key for long-term planning. By knowing how the timing of returns can impact your investments, you can use strategies to protect your money and improve your chances of reaching your financial goals. To fight the effects of inflation on your investments, it's essential to increase your contributions as your salary grows, ideally at a rate higher than inflation. Inflation makes money less valuable over time, so if you keep contributing the same amount year after year, it will have less impact. By boosting your contributions in line with or above inflation, you ensure that your investments keep up with the rising cost of living and continue to grow in real terms. For example, if you're putting $500 a month into your investment account and inflation averages 2% per year, keeping your contributions at $500 won't be enough. In a few years, that $500 will buy less and contribute less to your investment goals. To counteract this, if your salary goes up by 3% each year, aim to increase your investment contributions by at least that much. So, if you increase your contributions by 3% annually, your $500 monthly contribution would become about $515 the next year. This increase helps your investments grow not just in number but in value, staying ahead of inflation and maintaining your purchasing power. Regularly adjusting your contributions helps you develop a disciplined saving habit and take advantage of salary increases to boost your investment portfolio. It ensures that as you earn more, you save more, allowing your investments to benefit from larger contributions and compounding growth. By planning and regularly increasing your contributions, you can protect your investments from inflation and maximize your financial growth over time. This proactive approach is crucial for maintaining the real value of your investments and achieving your long-term financial goals.